It was a time of unprecedented growth, a miracle of economic engineering that transformed skylines and fortunes. In the late 20th century, the world watched in awe as the Asian tiger economies roared to life. Across Southeast and East Asia, a symphony of progress played out. Skyscrapers pierced the clouds. Bustling markets overflowed with newfound prosperity, and stock charts climbed relentlessly upward. This was not just development. It was an economic fairy tale, a testament to globalization, and a promise of a future without limits. For years, the tigers seemed invincible, their momentum unstoppable. But beneath the glittering surface of this economic boom, a financial storm of unimaginable scale was quietly gathering strength. The first crack in the facade appeared in the land of smiles. On the morning of July 2, 1997, the world's attention turned to Thailand. The Thai baht, once a symbol of stability, was suddenly under immense pressure from speculators who had bet against its overvalued peg to the US dollar. After a futile defense that drained its foreign reserves, the Bank of Thailand was forced to let the currency float. The impact was immediate and catastrophic. The value of the baht plummeted, effectively shattering the foundation upon which Thailand's economic miracle had been built. It was a single decision on a single day that would ignite a continental firestorm. The first domino had just been tipped. The contagion spread with terrifying speed, a financial plague sweeping through the region. One by one, the dominoes began to fall, each marked with the flag of a once booming nation. From Thailand, the crisis leaped to Indonesia, then to South Korea, and sent shockwaves through Malaysia, the Philippines, and Hong Kong. Currencies collapsed, stock markets nosedived, and decades of progress evaporated in a matter of months. As local economies buckled, a sense of panic gripped international markets. Shadowy figures representing global hedge funds and foreign investors, who had once poured capital into the region, now pulled their money out with ruthless efficiency, accelerating the downward spiral and leaving a trail of economic devastation in their wake. At the height of the chaos, a new power entered the scene, the International Monetary Fund. Portrayed as a savior, the IMF arrived with briefcases full of billions of dollars in bailout loans. But this aid came at a steep price. The money was tied to strict and often painful conditions known as structural adjustment programs. Governments were forced to slash public spending, raise interest rates to punishing levels, and open their battered economies to foreign ownership. The medicine, intended to cure, induced severe side effects. Across the region, social unrest erupted. Millions were pushed back into poverty as businesses closed, unemployment soared, and the social fabric began to tear apart under the strain. From the ashes of the crisis, a long and arduous recovery began. The once mighty Asian tiger, now thin, wounded, and humbled, slowly started to get back on its feet. The ordeal forced a painful but necessary period of reflection and reform. Governments implemented stronger financial regulations, improved corporate governance, and rebuilt their foreign currency reserves. Recognizing their vulnerability to external shocks and the harshness of the IMF's conditions, regional leaders came together. They established the Chiang Mai Initiative, a multilateral currency swap agreement that created a regional self-help mechanism, a safety net designed to protect them from future crises, ensuring they would never again be solely at the mercy of outside forces. Today, the echoes of 1997 still resonate. As we look at the world, a split screen reveals a haunting visual parallel. On one side, the frantic panic of the Asian crisis. On the other, the stark imagery of the 2008 global financial meltdown and the market volatility that defines our modern era. The principles of rapid capital flight, currency speculation, and systemic contagion are not relics of the past. They are recurring features of our interconnected global economy. A modern, fluctuating digital stock ticker serves as a constant reminder of this fragility. The question, therefore, remains: have the hard-learned lessons of 1997 truly prepared us for the next inevitable economic storm? Or are we destined to watch the dominoes fall all over again?